Thank you. Within the last few hours, the Federal Reserve announced its decision to hold interest rates at their current levels. They also signaled they are still worried about inflation and may hold firm instead of cutting rates at the next meeting, which is going to be held in March. Here's what Jerome Powell, the chairman of the Feds, had to say about those concerns.
My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we're strongly committed to returning inflation to our 2% objective.
The Fed has raised rates 11 times since March of 2022. It caused mortgage rates and credit card interest rates to rise significantly. And joining me live now to discuss what this means for your credit card and mortgage payments is Bankrate senior economic analyst Mark Hamrick. Thank you so much for joining us this afternoon on the 5:30.
Good to be with you, Claudine. Thank you.
Let's start first with credit card debt. Everybody has it probably. What does today's decision really mean for people who may be trying to just pay off their credit cards?
About 50% of Americans are maintaining some credit card debt, and those levels are really costing them a minimum of 20.75% in terms of annualized interest rates, and 50% of those do not pay their balances off at the end of every month. One interesting thing about credit card interest rates is they really do move in lockstep with what the Federal Reserve does. It's just that the banks, the issuers, maintain a premium over that baseline rate that the Fed maintains. And so the translation of that is until the Fed actually starts cutting rates, those credit card rates are going to remain elevated. So we want people to try to pay off their credit card debt as soon as they can so that those punitive costs don't keep them from achieving their other financial goals. Right now, it's the best bet that the Fed will start cutting rates in May, not March.
Interesting to know that. Now, this morning, Bankrate reported the benchmark 30-year fixed rate mortgage was 6.9%, which is down just a bit from the previous week. Where do you expect mortgage rates will go based on the Fed's decision and guidance?
Yes. First of all, let's think about the fact that before the pandemic hit, we had 30-year fixed rate mortgages basically in the 3% range. And so there are a lot of people who are sitting pretty with the mortgages if they haven't paid them off that are really sort of at that 3% to 5% range. And we topped out at 8% in October. In terms of the outlook, our forecast is that we should see the 30-year fixed rate mortgage, really the workhorse of home purchase finance, get down to 6% by the end of the year. And if we're on the fortunate side, we could even get down to 5.75% on that 30-year.
Interesting. Federal Reserve Chairman Jerome Powell, you probably heard him earlier, said that he's worried inflation could remain above the Fed's preferred target as one reason they may not cut rates. What should people consider when deciding if this is the right time to apply for a mortgage or refinance their mortgage?
Well, I was at the news conference, as I typically am, Claudine, and so I heard it out of his mouth at the time. And really, he didn't say anything that was tremendously surprising today. Most people don't tend to time their financial behavior based on the outlook for interest rates. But what I would say is that we are probably now witnessing either peak rates or some rates have peaked in back of us in the sense of having just talked about that 30-year fixed rate mortgage. We may see some easing of credit card interest rates later this year. Maybe we'll see a little bit lower with respect to auto loans and other borrowing products, but it's not going to be crashing. And the thinking really is that although we lived through about 15 years of record low interest rates are going to remain higher for longer, just perhaps not as high as they have been recently. And of course, those who are invested in the stock market, which includes just about everybody who has a 401k, the stock market's been rallying to record levels in anticipation of rate cuts. So in a sense, we're already being helped by the fact that the Fed is seeing cutting rates as we get into spring.
Excellent information. Mark Hamrick is a senior economic analyst at Bankrate. Thanks so much for coming on the 5:30 today to talk about this important topic for sure.
Thank you.
Thank you.